short, things are going to start moving and accelerating fairly soon. I'm going to go over some things with you. I've shown you my timing model over and over and over again. Let's take a look at two simple mathematical calculations that you can do, and you can see where chaos is going to come into the marketplace. Now, I'm going to show you my timing model. Then we're going to talk about the rent to own ratio. So simple to do. You can do that at any market, and it'll let you know where you are in that particular market. And we're going to talk about the cap rate. Now, cap rate is a little more sophisticated. Now, investors use cap rate all the time. We use that and every last one of our properties we buy that for a reason. If we don't get cash flow, we're not going to buy this thing. You know, if we can't make money on it, we are investors. We're there to get the highest return for our clients. And we've got statistics. And if the cap rate's not there, well, we're not going to buy the property. So let's talk about the cap rate and what that means for you. So let me go to my very first slide, and let's just talk about what we see here. And that's my timing model. So look at the timing model. We have talked about this many, many times. Now, this is just simple. This is taking a look at basically on an 18 and a half year cycle completion. Nobody says it has to be exactly 18 years. You know, it can be as little as 16 and a half, 17 years, and it can go up to 21. You know, we had one in Phoenix here, ran 21 years. It was a long cycle. But they all come to completion, and they come to we get signposts and guides along the way telling us where we are in a cycle. So I'll tell you, I feel very confident that we have peaked and we're coming down on this side. Now, remember all the fun we had over on this side? This is where prices were going up virtually every single day. Homes were going up. When you get over here to the explosion phase, we actually even had months here in Phoenix. They went up 3.5% in 1 month. Now, for 40 years, we had a 3.98% annual appreciation rate. This went up 3.5% in 1 month, like 35% for the year. It was pretty doggone amazing. And then you get to the top. And of course, this top is not a time frame. It's a process. You know, this takes a little while to do. It's not a point in time. It comes down, and now we're rolling down to the side. Now, once you get down around here, events start happening. And this is where it starts to come down. This is called the waterfall event right through here. This is where you get debt and capital destruction on massive scales. This is why I've been saying I don't know that we're going to get inflation. We may very well get some deflation, because deflation is credit deflation. Remember, as you're adding money to the system is inflating. When you start getting foreclosures and capital destruction, like people aren't paying their loans, then you have deflation. The bubble deflates, and that's really what we need. We're going to talk about that as well. But I'm thinking we probably have that before we get inflation, because you know what will happen? We're going to have policy response. And what's the policy response? Policy response is always, we're going to throw money at it. Particularly, we have President Trump. He's a real estate guy. He understands this. Probably one of the greatest people we could possibly have in office to review these things and go over that with us. Let me excuse me. Let me go to my next slide. Let's just take a look and take a quick peek as to where we're at. Now, this is real simple. The rent to own ratio, it should cost you just about the same amount of money to own a property as it is to rent. That's just what the market is telling us, particularly when you're dealing in the affordable home space. You know, there's affordable rent and affordable homes for purchase. Now, when you purchase, of course, you have to have a down payment, and you have to have good credit, and you're assuming that you're going to be staying in place for a long time. You're setting down roots, but the payments generally wash each other out. So normally, rent over owning equals 1. You know, they're about equal. So we're talking about, if you were going to purchase a property today, it costs you about $6.32 $1,000 for every $1,000 that you borrow. That's at 6.5% with a 30-year fixed mortgage. Median rental here in Phoenix is between $1,900 and $2,100. Now, the median sales price in Phoenix is $448,000. That results in a median mortgage payment of $3,000 to $3,200. Now, that's a far cry. That's a far cry from $1,800 to $2,000. $1,900 to $3,200. That ratio is whacked. That's not going to work. And let's just talk about what that is. So let me show you the difference. Now, this is what simple math. You can do this in any marketplace that you're in the United States. Anywhere it's going to show it. Rent should equal owning on a payment. We get benefits on each one of these. When you're renting, you don't have to pay for the repairs. And in owning, you get deductions. So they kind of wash each other out. Maybe not quite so, but they're pretty close. They're pretty close. People can afford X amount of dollars, either whether you're owning it or you're renting it. You still have the same monthly payment. That's the median home payment for housing, whether it's rental or own. Let me go to my next slide here. Let's just talk about that one. So when you look at rent to own, $2,000 versus $3,100, that means that today, if you just did a simple rent to own ratio, we're looking at a 32% overpriced. Now, if we take the median home price, and this is what it is in Phoenix, it's right around $450,000, $448,000, and you plug in what it's overpriced just based on your rent to own, that means we're $144,000 overpriced in the median. $144,000. Now, look at the payments: $3,100 minus $200 versus $2,000. So the payment now is $1,100 overpriced. So let's do one more calculation. What's the $1,100 payment differential? Well, at $6.32 a thousand. We just had that on a previous slide. It means it's $174,000 overvalued on a median Phoenix home. So either it's $140,000 or $170,000 overvalued. Whatever it is, it's not good. You can do this in any marketplace that you're at. Very, very simple math. I'm not telling you it's absolutely empirically perfect, but it's a great guide. When you get that far out of whack, certainly there are fluctuations in markets. Sometimes it goes up, but they're always very close. Not now. It is really out. So we're looking at over a 30% decline just to get where we're supposed to be, according to this easy math. Now, if you go to back my videos, we've been talking about the fact we think we're 15 to 30% overpriced here in Phoenix. And look at this. This is just confirming what my model is telling you. By the way, if you like my videos, I work pretty hard at this, and I'd love to get your comments. This is for you to make money, become wealthy, to get out of debt, to get yourself a great retirement account for yourself. It's easy for you to get $5,000, $10,000, or $15,000 a year. I'm sorry, a month, not a year, a month in income just by following these simple strategies that we're teaching you. You can do this. Change your life. If you like my videos, give me a big thumbs up. And would you subscribe? We're not gonna send you any requests for anything. But those algos over at YouTube, my, does that drive them crazy? They just love that. And of course, it'd be nice we're trying to reach as much of a market as we possibly can. Let me go to my next slide. Let's just open this up a little bit so that you can see this, because this is pretty interesting. I want to get to this. Now, we have had a slide in interest rates from 1981 to 2020. And it came down. Now, I'm going to tell you, for all through the great financial crisis, we were looking at very low interest rates. And they bottomed here in July of 2020 at 0.62% for a 10-year. Now, that's what you're getting return on your money. This is risk-free returns. It's 0.62% July of 2020. Now, Dr. Nenner did a video with me, and he said it bottoms in, and he was absolutely correct. So when you're looking at some of our properties, now we've had a benchmark here in Phoenix for our marketplace. My slice of the pie, and we have been looking at really about 4.5% cap rate, and that's been holding for really like 7-8 years for us. That's just the return on your investment. That's just the cash flow. Now, there's other returns, when you're in real estate, unlike stocks and bonds. We get the tax savings, we get appreciation, we get depreciation, so more tax savings on that. And if we put any kind of loan on there, we get principal reduction. So it's a pretty good program for us. But a cap rate tells us what our cash flow is. What does this building generate after costs? That's all it is. So all it is just telling us what. So when we put in our formulas, of course, we put in for homeowners insurance, or for landlord insurance, HOA fees, taxes. We put in repairs, management costs of sales for it, and a sinking fund. And of course, there's no mortgage on this. This is just a cash transaction telling us what this building is, what will it return to you, and what will be the debt service available for you. So you'll be able to see what the cash flow is. Now, that's been 4.5%. Let me just open this up a little bit. So when you're looking here, when for like a decade, you've been getting less than 2% for your finance, if you go to risk-free, when you're looking at Treasuries, and they're here between 2 and 3%, well, a 4.5% with tax savings, principal reduction, and appreciation looks pretty doggone appealing. And then it bottoms here in 2020 at 0.62%, and we're getting 4.5% cash flow plus all the other benefits. Well, goodness gracious, that was a really, really good deal. You can see why all the iBuyers, institutional buyers, jumped into the marketplace to buy this, because they are getting almost 4% more than what you get at Treasuries. That's like eight times the return that you get from a 10-year Treasury. Pretty doggone good. But what happens when the cap rate, when the Treasuries rise? Because this is where we went. And now we're at 4.63%, more than what our cap rate is. So for virtually a no risk investment, you can get 4.63%, and that was January of 2025. We just took a look at this. What does that do to your cap rate? What does that do to your cap rate? Well, look at this. If cap rates go up, prices go down. What's the reason we're buying this property? The only reason we're buying this property is to get cash flow and return on our investment. And there's risk involved when you put your down payment in. You're stuck into an asset class. We have all kinds of things. Look at those people in Florida and in California. They have fires and hurricanes. There's all kinds of things that can happen. It's not risk-free. Now, we do a really, really good job, but it's not risk-free, and you can get 4.63% risk-free, and we're at 4.5. Well, who wants to do that? There has to be a premium that you're going to get if you are putting your money up and you're taking risk. So let's just go here. Let's just open this up again, and let's just take a look at my next slide. So let's just talk about this. So return is easy. This is something you can do any marketplace in the United States. Return is the cap rate times the value gives you your return. Really, really simple. But value equals return divided by cap rate. Now, most of our properties here, we're in the $400,000 price range. They are going to give you about $18,000 annually cash flow. This is a net cash flow for yourself. That's after management company, absolutely all the costs. We got repair escrows in there. We're paying the taxes, the insurance, the HOA. We're escrowing in case we have to put a refrigerator in or a roof in. So it's pretty complete, and you're going to get $18,000 a year. Now, we've been looking at a cap rate at about 4.5. Now, I'm going to tell you that most of the properties we buy are right around $400,000. So we get the 4.5 cap rate at $400,000. Now, we always try to get these properties for, $370, $380, $390, whatever it is, but we won't go over 400 because that gives us our cap rate. So this is called our walkaway price. If we get to $401,000, well, we're on to the next property. Now, look what's going on. If you just raise it up to 5% return from a 4.5 to a 5% return, look what happens to the value. This is what you're going to have to do. You're going to have to go at least a 5 cap rate just to be comfortable with a tax-free. I mean, this is almost like just meeting what you can get tax-free. You know, what's 2 months ago or 3 months ago, you could get your money market was returning over 5%. So $18,000 return. This is going to stay the same because rent is rent, but our return changes. So if we get a 5% return, we want to get 5, then we can't pay $400,000. We can only pay $360,000. And of course, we're going to want to buy it for $330,000, $340,000, $350,000. So what happened to the price? We can't pay $400,000 for it because the cap rate needs to be at 5 just to meet the other asset classes that we're dealing with. So if you can get a risk-free asset at 4.63%, why would you not do that? Particularly when we're in a risk jeopardy here. Remember, I keep saying we're at risk. So why would you do that unless you get some kind of reward? And if 5 only gives you just a little bit better than what you can get in the Treasury, so it's probably going to go to 5.5 or 6 just to make it worthwhile, because I'm not going to put my money out for that. We've been on a moratorium, and that's because the prices have been too high to entice us into purchasing the property. We're not getting enough return. You can do this in any market that you look at. You can do any house that you want to buy, you think is a rental. Keep in mind, only like 1 in 10, 1 in 20, maybe 1 in 30 properties makes a suitable rental for us, because we don't buy properties and then turn them into rentals. We buy rental properties. They're purpose-bought rentals, so they have to fit our requirements. And so not every one of these is going to work. And one of the first things we do is the cap rate, to make sure that the cap rate works for us and we get enough return. My job is to make sure that I get a return for my investors. Let me go to let's open this up and let's just talk about this. So what happens if it goes to 6? Now, this is where we would be interested. We'd be looking at a 6%. So most of the houses today are really priced here at 4. I'm going to go over. I'll show you a couple. And I think they're going to go to $300,000. I think we're going to go to a 6 cap. Now, if rates rise at all, it's going to get brutal. Now, this is already in the marketplace right now. It's just that market has not recognized this. And I'm going to tell you, you are soon going to see institutional owners of residential properties are going to start unloading. They're starting now. You can just see them just a little bit. They're starting to unload their portfolio because they're not profitable for them. And how do you value a property? Everybody knows this. Everybody in the world, in the United States, knows what a real estate comp is. That's the last 3 properties that sold in your neighborhood, like yours. That's what a comps. That's what an appraiser looks at. What's the last 3 neighborhoods sell for? And if any of those happen to be institutional renter properties, institutional investors, and they're starting to unload, the price drops. And everybody comps it to declining properties. And that's how you get a waterfall, is that they start to sell. And they start to sell, they were at 4, then they went to 350, then they went to 330, then they went to 320. And you start coming down, and it kind of puts a little bit of panic. So people think, hey, I've got $200,000 in equity in this property because I bought this in 2015, and I've got a lot of money. Now I realize I only have $150,000. I'm going to sell now and keep my profits. This is what happens in the marketplace, and you can tell this by just looking at the cap rates and knowing what you're looking at. Let me go to my next slide, and let's just take a look at that. So I'm telling you, these are here in my marketplace right now. This we've talked about before. This was an institutional buyer, just bought this property. They bought it maybe 7 months ago. It peaked at 427.4 right in the middle of 2022. June 2022 is when prices peaked here in Phoenix. But they're looking back in the rearview mirrors. They were able to buy this property for $368,500. They're thinking, well, we put some paint in, put some flooring, and clean it up, and we can sell it for a profit. That was not going to happen. They ended up putting it back on the market. I probably talked about this in my last videos. They put it on the market at $361, $7,500 less than what they paid for it. But of course, they put money into it. They've held it for 7 months. And of course, they have to pay fees. They have to close the property. They have to pay their commissions. They have to, they're going to go through inspection. Anything wrong with the property, they're going to have to repair it. So they're going to lose a ton of dough. Now, do you understand that? This is now a new comp. They bought it for $368.5. They sold it for less than $361. And in their literature with the house, they said they're more than happy to give a concession. So you have to realize that they probably paid 3 or 4% in concessions on top of that. So the net for them is probably going to be $340, $335, and we would have been interested in that around $300. So the market hasn't gotten down, but it's that trend that concerns me. Let me go to my next slide. Let's just open this up so you can see it. Let me go to the next slide. You can show you. Now, this is coming out of our portfolio. We purchased this property right here at 315. This is an absolutely outstanding piece of property. It's a 4-bedroom, 2-bath, 2-car garage, right in the path of growth. Maybe it's 15 minutes to the new chip plants that are being built in the new high-tech areas. It peaked again. This is interesting, is that in our research, we peaked in June 22. You can see this is coming out of Zillow. They also show the property peaking at 222 at $510,000. I talk to my clients. We do an annual review, and we thought, well, if you want to sell it, it's probably now the time to sell it. But no one wants to do that because they've experienced this big increase, and I think it's just going to continue, but it doesn't. And it's rolled over, and now it's worth about $415 to $425, and we think it's coming down. So you can see the process is already, this is our portfolio. Now, you have to understand, we are pros at purchasing. We don't pay full retail. We never pay full retail. We get a deal. We always get a deal. And our property is down to this. We paid $315. Now, if you'd have bought that in 2022, just think, we quit buying in mid-2022. A lot of people didn't. Let me go back to this slide. Let's just talk about this. If you'd have bought this property thinking, oh man, this thing is just gone like a rocket, I need to get onto the train because it's moving fast, and you'd have bought this in June of 2022, you would have lost $90,000. Now I'm going to tell you, in this price range of $515, I know it sounds like a lot of money, but not too many people are putting 20% down. Most of the people put 5% down. FHA, maybe they're putting 3.5% down. So maybe they had a $460 mortgage on the property, and now it's worth $415. So they would be underwater. Virtually everything, if you'd have bought it in June of 22, when we stopped, you'd be underwater. You would definitely be underwater. So, and I think this is going to continue down. I'm thinking we'll probably bottom. So now we'll probably, this is early, we bought this in March of 2020. It's probably going to come down to here and actually just probably retrace past the 2020. So that's just what we're thinking that's going to happen. You need to realize that there is real risk in the marketplace. You need to really talk to someone who knows what the heck they're doing. Now, this is building up to, let me just go through this and show us what we have. So let me go to my next slide, and let's talk about that. Now, you can see that the market is confirming our diagnosis. What our model is saying is that we have the lowest existing home sales since 1995. The lowest. We didn't even do 4 million. I think we did like 3.9 million, and we've had over 400,000 real estate agents come out. I understand in 2023 here in Arizona, there was 47% of the agents in 2023 didn't have a sale for the whole year. And I'm hearing in 2024, it was 73% of the real estate agents did not have a sale, because we've lost 400,000 realtors. So it's the lowest share on record. Now, it's the if you take a look back, it goes all the way back to 1995, 1996 to get where we're at. And of course, we've got 75 million more residents. So that's a pretty drastic number for that. Pending home sales just crashed, just literally crashed, and interest rates were better. So something is in operation here. Now, I want to tell you, this is something that you need to look at, is that I think we're going to have probably a good first quarter for approaching into the spring. And I say that because of this liquidity release right here. Now, what was happening here, this is January of 2024, is that we have elections. And the Treasury and the Fed put a lot of money out, a tremendous amount of money. So much money they were in, and not only that, but they were at an 8% deficit spending as if we were in a Great Depression. It's like wartime spending. This is just terrible. Nobody does that in peacetime or in a recession, but they did. So if you remember, I thought we were going to run into, I thought the recession had really started in the fourth quarter of 2023, but these guys in the prior administration just spent and spent and spent. Now, I got this. Now look at this. Look at this. You can see that liquidity was pumped in and it went up. They put a lot of liquidity in. What is going to happen when they put that liquidity in? What's going to happen? Well, that's why I think we're going to have a fairly good quarter. So I'm telling you, this is going to be probably your last chance. If you've got an asset you need to sell or you're tired of, you want to do something with, I'm going to tell you, you better get it on the market. You better get this thing sold, because I don't think summer is going to be a good market at all. I think we're going to have major problems before then. And my next video, we're going to talk about why I think so. And it has a lot to do with the new administration coming in. And they're, instead of all this bloated spending, which has been throwing money into the economy, all that's going to start contracting. That's why I think inflation is going to come down as well. They're talking about taking $1 trillion of spending away. And of course, they're looking at eliminating 1 million government jobs. So just like a major recession, this is going to have ramifications. And that's going to hit us right in mid 2025, right in line with our timing model. So if you need to do something, talk to your broker. Time to do that. Because this liquidity pop right there, that's not going to last for very long, because they're already talking about taking that out. They're already talking about, now this is coming, you can see September 2024. What was right before that? November of 2024. And isn't it amazing that we had this huge boost of liquidity gets popped into it in just a little bit, but it's just going to fall off on the other side here, probably fairly severely. Let me go to my next slide here. Now, you can reach me for a private consultation. We're looking at portfolios. We are looking at where you want to be. We're taking names and numbers, and I'd like you to get comfortable with me and me comfortable with you, so we know each other. We want to build your portfolio. We are instituting I can see where we're gonna bottom. You know, my models have been very negative for really 2.5 years, and we've put no new capital out. We've been saving it and piling up our cash, because when this bottoms, we're going to buy. I'm going to tell you, you're going to be scared to death. You're going to say, I'm never buying another piece of property. And that's because prices I expect to come down fairly drastically all across the country. Even here in Phoenix, I think we're going to get, we're not going to be immune. So we'd like to take advantage of that. If you are interested in that, you should probably contact us. We'd like to, there's a process. We need to, onboard you, talk about financing, what you want to find, what your goals are, so we can start thinking about portfolio. We need to really get to know you, and you need to get to know me, so we can do this properly. I think this is coming. I think it's coming very quickly. I see a huge buying opportunity. I think you can get well. If you haven't done very well, you had some investments that you missed. I think this one's coming. It's going to be scary. I'll tell you that right now, because the economy is going to be pretty ragged, I think. Anyway, give me a call. This is our corporate number. Just ask for me. I'm around most of the time. We'll set a time that you can reach me, and we can We can either chat or we can do a video chat anywhere in the world. You know, a lot of my investors have never seen their properties. They just get the check each and every month. That's what they're interested in. So my very best to you guys. Bye bye now.